All right, I'm back. Let's get this out of the way. All right, any questions? All right, get your favorite pairs to trade. I like to look at the majors, GBP, CHF. It's one of my favorite pairs. It seems like you can stumble on 50 pips in GBP, CHF. It has a nice, good move. And I like EJ. You know, pound yen is considered the beast, and even though the market's more subdued, it still has higher ranges than everybody else. Okay, good question, Joe, about safety trade. Let's see. Do you take the first leg or wait for the second leg? What if the second leg never shows? Okay, that's part of, if the second leg, no pictures right now. If the second leg doesn't show, there's no trade for you. If you are going to be of the discipline that you always wait for the second leg, and that is what I recommend, then you're going to have less trades, but you will be more accurate. Yeah, it's just a blue screen right now. All right. Is there sound? There is sound, right? Okay. All right. Here is a pop quiz. Get your little picture takery thing out so you can take some pictures of these, but I'd like you to mark them. I'll go full screen on you guys. Hold on. Okay. Yes, don't go against the peak. Yes, Helen, I've been saying that all year. The best thing you can do is be a safety trade setup, wait patiently for that, and trade it. Okay, label everything you got here we talked about. I know, but it's got to be a good confirmation. It's got to be the right setup. It's got to be right directional bias. It's got to be in line with the peak. Okay, go. I'll be quiet for 2 minutes, and then we'll do another one. Take a picture of this if you have a chance, and then if you can't do it today, mark it and email it to me. I'll look at it. Okay, 1 minute left. All right, did you get it? That was less than a minute, but I have no patience. Yeah, we were waiting for this chart. Okay, look, let's talk about it real quick. I don't want to give you, I'm going to give you the answers, but on the next couple, I want you to really do them. I know you're just sitting there going, oh, I'll kill a few minutes. Look, Asian consolidation, 3 to the low, 1, 2, 3, below the mayonnaise, in the Brink shadow box, in the stop hunt zone. TDI has offered a cross below the support. Outside structure, quasi second leg. But if you take a position in here, after the outside structure is formed, you're good to go. Bam, stop loss goes below the dealer's grasp. Okay, see it? VJ, by the way, 15-minute. Did y'all get those? Tight Asian range, 1 a.m., 3 to the low, trading below the mayonnaise into the stop hunt zone. How deep is that stop hunt? Anybody? More than 50 pips, right? Why? Because the box starts from 25 to 50. So that's about a 52 or 53, yeah, good guess, 55 pip stop hunt. All right, that's a good quality stop hunt, outside structure to the low below the mayonnaise. Perfect. That's what we live for. Okay, label this one. Okay, wait a minute. That's a problem, Scott. Hold on. You don't see 3 to the low? You see 6 bars going down. I see 1, 2, 3 to the low. Push, push, push. Swipe, swipe, swipe at the stops. Ping, taps it, comes back above, holds the level. Okay? In 45 minutes, the dealer extended the stop loss in 3 aggressive vector candles to the downside. Ignore these little babies. It's hard to see a W down there. Right, but it's an outside structure. It is a W. It's its different form of a W. This is a 55 pip move to the downside. Picture that as one big spike candle, and then the dealer comes off the level and trades in here. Okay, he's not going down that level for how long? 30 to 90 minutes, up to 2 hours. One, the lowest set. Okay, the lowest set, that's 0. 1, 2, 3, 4, 1 hour. 1, 2, 3, 4, 2 hours. The low is not violated ever again for the rest of the cycle. But if you take a position calmly in here, maybe on that little hammer, maybe on a little tiny pullback, but when it's the low and holds it for up to 2 hours, that's okay. You have all the other elements are available or present. What are the other elements? Tight Asian range, 3 to the low, past the mayonnaise, in the brink shadow, down to the stop hunt zone. TDI fires a signal and it holds. That's an entry. All right, back to this one, okay? Brinks trade, hits the M formation top. If this trade doesn't go anywhere and you scratch out in 2 hours and the dealer comes back to the level and forms a wider M, the M is divergent, out of the band, in the band. There's the second signal. If you scratched out here, that's okay, but when the dealer repeats the level, take them again into the session. Okay, the high of the day is formed in the brink shadow. I could see why you might have shorted that, but if it didn't produce and he comes back to the level, you scratch out and take him again. And then you get your payoff. Okay? It's best to take a position up in the shadow. If you're here and it doesn't break the high, that's a big multi-session M, quasi multi-session, because it's the high was formed London and then late London going into US. How often should you check your trade in the initial 2 hour period? Every bar. See what's doing. You got to know if the dealer closes above, and then if he does, you wait 15 more minutes. If he hasn't hit your stop yet and starts coming back below, you're good. If the next candle closes above the previous high or below the previous low, scratch out. Take yourself off. Get off the board. Okay? Here is a little baby Head and Shoulders. Good entry right there. The low's here. He hit it one more time, came back above, then shouldered for you. That's a good entry right there. Divergent. In, out, in. Okay? 3 to the low. Pushes aggressively. Pings it. Holds it. In the shadow. This is a true Brinks trade. The low is formed in the shadow. There's your signal right there. All right, same type of stuff. This is CAD, but GBP just did it. They work the 4 hour line above the mayonnaise, or I mean above the blueberry. Work it, hold the level, and then correct. These are the things you got to develop. Joe's going to talk about this tonight. You got to develop your vision for this stuff. Here's GC. Nice aggressive move into the stop hunt zone, about a 45, almost 50 pip stop hunt. Open the spread, it probably was 50. Above the blue tracer. Railroad tracks. Confirm, close inside the mustard, close inside the ketchup. Sideways, hit the stops, gone. I'm going to show the TDI in a few minutes. We're going to go over it, okay? Vector. It's just variations on the theme, man. There's the W to the mayonnaise in line with, right, all the elements. Let's go through all the elements. What's the list? All the stuff for the pattern. 41 pip Asian range at 1 o'clock. That's good. I like that. Right? We know the overall trend is up. This is probably day 2 of the cycle. We have a nice 1, 2, 3 to the low of about 52, 53 pips, right to the mayonnaise. Dealer pulls back, hits it again, taps right below. The number will change on the big board by a few pips, comes right back above. Good entry there, good entry here, gone. Top side, move, EOD, end of day. I could tell you that this move is, just by looking at it, 41 and 25 down to here and 25 down to here. So 41 and 50, 100 pip move. I don't look at this over here, man. I want you guys to get out of that habit too, okay? I don't look at this crap over here, the numbers. I don't care what the euro's at. I don't care what pound yen is at. I don't care what GBP CHF is at, because it's the same crap. All right, what is the setup called? W formation, pins to the mayonnaise. This is pins to the mayo. Green and red arrows are when the intraday signal lines have crossed. I don't want you entering here. It's a signaling system. This is a added confirmation method. All it is to let you know you're in the right directional move. Okay, because here's what happened. Here's the entry down here. You wait for this crap. That's when the shift bar usually fires. When the averages cross over, you're going to get a shift bar, and it usually is the shift bar that pierces through the averages and gives you a solid crossover. And by the way, it's not till the bar closes that gives you a lock on this. So if you're waiting for this, you are too late to the party, my friends. It's not what I'm teaching you here. I'm teaching you to grab, this is middle of the range shit. This is for amateurs. Okay? That's not what I'm teaching you. This is no man's land, or no woman's land, or no adolescent's land. This is just no land. Get out of there. Your job is to trade this structure here and this structure here without fail. That's your job. Okay? That's why I told you, come to your terminal in the first few hours. All right? Come to the terminal in the first few hours, and then come back to your terminal in the last few hours. And you're looking for this structure and this structure. Why do I have them on there? If they confuse you, take them off, man. I'm not going to be offended. They're on there because you would like to do checkpoints along the way when you're taking your trade, and I'll show you how to do that with TDI coming up. But what happens is that you have your W, you enter low, you're waiting, the dealer hits the stops. Now, this is one of those trades where the dealer made the first level consolidation close to the entry because the mayonnaise was there. So if you got in here or here, you actually come back into a negative position. But since the low is not violated, this trade is still valid. This arrow firing lets you know the zone has been shifted. There is a crossover on the averages, and if you know how to read the averages, on average, price is increasing. Right? It is closing above the mustard. On average, there is a crossover. On average, price is increasing. And that is an added confirmation signal that the right directional move. Angle separation of the averages, the signal lines, gives you to know that you're still in a good position. And then this is the alligator, if you see it or not. Okay, let me show you this. Here's the alligator. There's an eyeball. Look at the averages. Don't look at the candles. There's the other eyeball. And the gator is opening his mouth. See it? I'm a terrible artist, but there's the gator. My wife loves that because she's a gator. All right, look, gator. It's opening his mouth. We know when the gator mouth gets too wide that they will score a touchdown and take your money. Okay, do you see it? That's a horrible gator, but look, that's what's going on. So this signal lets you know that the averages have collapsed. Why is that significant? Well, on the reversal trade, you'd like to see a collapse inside the mustard and then a crossover. There's your shifting of the zone. The arrow fires. You're in the right directional move. If that bothers you, take it off. I'm not offended. All right. Tom, send me a picture of what you're talking about. I'll look at it for you. All right, one or two more charts, and then we'll get on with the show. All right, I'm trying to find a good one for you guys. Oh, this is a cool one. This is a structure. Typical structure, right? Look, news release early. This is Australian, by the way. Dealer came in, peak formation. Okay, very erratic, but I want you to see something pretty cool. There is a quasi safety trade right there. I actually took this on the first leg right here, not the second leg W, because I thought this was a beautiful W, and I took it. Took a little heat, but it paid out nicely. And then again, next night, W formation, rise. And then look, here's the typical structure. Now I want you to see what happened here. This will happen. Okay? This is your level 3 structure. Remember, where the dealer hits the stops, traps high, outside structure, and he comes back to it, and then he hits the stops one more time. So if you were short in here and didn't book, the dealer came back and hit you one more time. I don't want that to deter you because that's a railroad track set. You went in and out. So if you got triggered by those stops, the right appropriate action is to re-enter below the railroad track close because you know better what's going on. There's an old thing that goes around that people teach, and it's garbage. It's wrong. What I want you to understand is that textbooks will tell you if you get stopped out, stand aside. Standing aside doesn't make your money back. If you understand the method and can see clearly and have good chart vision, then the right appropriate action is if the dealer hits you, you hit him back. Okay, you're in a schoolyard fight with this dude, and if he hits you and takes your money, the only way to get your money back is not standing aside. It's understanding where you are in the cycle and that this reversal is imminent. And if you look at over the week and a half span, this is Thursday, Friday, Monday, Tuesday. Midweek reversal is imminent in the middle of the week. The dealer comes back one more time and hits the stops. If he got you out, if you shorted it here or here and he got you out, you need to enter the market. Okay, because if you think about it for a minute, you have 1, 2, 3 to the high above the stop loss level. The dealer issues a beautiful set of railroad tracks and closes right back below within 30 minutes. Below yesterday's high, blue tracer, right? He closes right back below yesterday's high and the day's high in one swipe. I want you to see it. I don't want to hide it. Okay? This is the structure you're looking at. You know that you have level 1, day 1, level 2, a weekend, level 3. 3 levels of rise into outside structure pattern that the dealer is holding and working L3. We know we're in L3. We can anticipate that the dealer may or may not hit the stops one more time. This looks like he did it here. So if you shorted here and he got you, you may have booked or scratched out here. If he got you here, don't worry. You got one more push. There's your third push to the high. You short here, even if he stops you out, without fear. The bias was short here because there was 3 levels of rise over about 3.5, 4 days because of the weekend. And this structure is what I just quizzed y'all on and showed you. These structures trading, look, a shoulder, head, shoulder as a peak formation level 3. And then you're trading quasi safety, hit the stops low, rise, level 3. I'm looking for reversals. I'm in L3. And I'm waiting. The dealer hits the stops one more time. That's lights out, baby. I got you. Going into midweek reversal. Sunday, Monday, Tuesday, he offers up the reversal, and it's over. Wednesday, back down to the previous low, and then we might get another reversal to end the week here. Remember, when the peak formation is set, this would be peak formation. This is HOW, high of the week, peak formation, right? When the peak formation is set, the dealer will make a unidirectional swing away from peak for how many days? 2 to 3. If he does it on Thursday, there's only 1 day left in the week, so Thursday into Friday, and he will end the day as a trap move. Always look how he ends over here. Trap. Gotcha. Okay? He went into, look, he ended the day in a trap, but then before 5 o'clock, before the actual changeover, he hit it again. These are the things you have to understand, variation on the theme. These are the things I can't teach you, that only from going back and studying and seeing what's going on, you'll develop these skills to understand. Okay, so you're trading a structure. Isn't that the pattern? Isn't that a bigger blow-up of the pattern? Right, do you see it? Now that I've illustrated for you, look, isn't this the pattern? Hit the stops, rise. It's always going to be hit the stops, rise, hit the stops, drop. That's their job. Their job is to hit the stops. So again, step back and look at this chart. Okay? Step back and look at this chart and realize, okay, what happened here? Price has been dropping, bam. Right? Notice how when the dealer finally look how he crossed the 4-hour with that excitement and vigor. Look at that. That is trend acceleration at its finest. This move this is a signal right there. Okay? And then almost crossing long is this shit, buy the dips trend. So I can't tell you how many people went long right here. And there's a lot because the dealer got the hell away from them. I can't tell you how many people went long right here, converted to a swing trade, and projected this when their trade was up probably, what, 80, 90 pips and came all the way back down, and they hung in there, and the dealer snatched it away. You are not trading small chart segments. You're not trading that. That doesn't mean anything. That, in conjunction with this structure, means something. This pins to the downside after the trend has been dropping, after vector, shoulder, head, enter shoulder, or shoulder here, or W formation next night coming out of level 1. Peak formation is locked. I got one move Friday to end the day in consolidation. That's it. I am trading a structured set of parameters that the dealer will illustrate over and over again that allows me to exploit his footprints on the chart, because the dealer is not sitting in his office going, he's not going like this. I'm going to paint a nice head and shoulders for Tom, and if Lenny's not busy later, maybe he'll notice this, and he'll trade that nice little head and shoulders. I'm not going to make a perfect little congestion chest hold on the chart and then make this little railroad tracks. That's not what he's saying. He's doing these behaviors, and when this stuff paints, it's because he went down there and snatched it away, went down there and snatched it away, went down there one more time, went down there one more time. He collected a bunch of contracts and had a shitload of orders sitting up here, and he would be remiss in his duties if he didn't make the firm an extra $500 million by going up there and getting it and then getting the hell out of there. That's what's going on. So as a trader, your job is to step back and look and realize, where's the money trapped? Man, the money's trapped there. Where's the money trapped? Man, the money's trapped there. Where's the money trapped? It's trapped there. Where did the dealer hit the stops and trap the money? And he trapped all the long holders here, and he grabbed the stops and pendings one more time and got the hell out of there. Where's the money trap to end the week? Right there. Where did he hit the stops high? Right there. Safety trade. Coming off a peak formation, level 1, bam. Remember how I told you the safety trade will be very aggressive? Look where the high was. That's one of those examples where the dealer made an aggressive move. So coming off of the peak formation, there's a huge distance. See that? Because he didn't go back into consolidation because he got the hell out of here. All the money trapped. That's what you have to ask yourself. Where is the money trapped? Where is the money trapped? Okay, so hit the stops high after an outside structure forms. You don't always get that hit the stops high. A lot of times it's safe to take 1, 2, 3 hits to the high without that stop. It's okay to take that 3 hits to the high on an outside structure. The correction usually comes. For whatever reason, the anomaly on the chart is there was something sitting there, and he would be remiss if you didn't grab it. So there he is. He grabbed it. And if you get stopped out on that, don't enter that, I don't want to hear about it. Shame on you, because you know what he's doing now. That is a classic reversal pattern coming off of a level 3 structured area. Without fear of loss, without failure, without thinking about it. When you see that, this consolidation, right? When the market is a big rise, they need more guys. When the market chops, man, that was horrible. When the market chops like this at level 3 after a nice run up, and on the third day he rose again, right? Third leg of the third leg, I kind of see it in there. It's too tight, possibly. There's some hesitation. 1, 2, 3, an aggressive 33 trade off of a stop hunt low rise, right? Coming in on the last leg of the last day, day 1, day 2, short Sunday, call that 2.5, and then day 3, right, the full day. Okay, well, there you go. Now, the dealer makes this structure, and I shorted here. He got me. Okay, so what? He got me twice. You ain't going to get me 3 times, you bastard, because I know there's 3 built into it. Do you understand that once you see this structure, and if you're not sure where it's going, it should become crystal clear when the dealer runs the railroad tracks above the high. If you were looking at that and you're like, man, which way is this guy going? Which way is this guy going? Remember I told you that if he goes above level 3, he has to come back below level 3 in order for it to be valid short. If he would have closed this and stayed above, that's a different story. Now we're anticipating this, 25 to 50 pips higher, right? But what's going on here is exactly what you need to confirm that you're in the right segment of the market. Dealer spikes above, railroad tracks above in 30 minutes and closes back below in 15 minutes. 15 up, 15 down at level 3 after 3 days of rise with a short Sunday in there after making the stop hunt low. And you got a 33 trade in here. That is lights out, game over. I own you. Pick up a Mercedes on Friday when it goes into consolidation. That's what's going on there. And if you miss that, you're missing the whole point of the class. I am not teaching you, oh, trade a couple M's, trade a couple W's. Good luck to you. That's not what's going on here. What's going on here is that you have to understand where the dealer is trapping the money. Where the dealer is trapping the money. Where's the money trapped? Notice how at the bottom of these stop hunts, there's pins to the downside on the mayonnaise. That's classic pins to the mayo. Notice how the pins and the trap moves are reaching to the top side and grabbing. He's going to correct. Notice how he reaches down and grabs. He's going to rise. Notice how he reaches down and hits the level 3 times with pins. He's going to rise. Those are the things that you got to see by stepping back and looking at the bigger picture. And those are the things that will give you the confidence to execute without fear, even if you've been stopped out once or twice. When they tell you to stand aside after you've been stopped out, that is the biggest falsehood in the business. Because what happened? You just gave them your money, and they go, we don't want you to try to take some of it back. Stand aside. Who made that shit up? The dealers probably put that out there. Sorry about the voice. Right? Think about who wrote that. Who said, when you get stopped out, stand aside? Where did that come from? I've always wondered, where did that come from? Do the dealers stand aside when they're in negative float? No. They trade through it. So the only way to make your money back is not to go to Tahiti when you lose. It's to trade through it by understanding the bigger picture and what the dealer's doing. I know that sometimes the hardest thing to do is to push yourself through after you've had a loss. But you got to expect and anticipate that there will be losses in the business and accept that, internalize it as part of the business. But understand that as the bigger picture, you're the bigger man because you said, you understand? You're new to all these things. You're new to these things now, but you understand it and you know that this is a new approach to the market and it's the right approach to the market. Standing aside is for chumps when you get stopped out. You come right back at the dealer and you hit him and you end the day in monster profit or at least break even. If you lost 3 times, a tight stop loss, 50, 60 pips will remedy that pretty quick. Okay? Good stuff. All right. Sorry. All right, I will. That's going to be pretty good. All right. Okay, any questions about this? We're going to roll over to the TDI. What time is it? 43? TDI might take longer than that. All right. We'll probably do, this is what I was thinking, is we'll do TDI. If there's something I didn't cover, if there's something you're concerned about, it's not over. It's the beginning. We're going to be together right after the holidays on boot camp. My remedy or my suggestion for you is enjoy the holidays with your family. When you have some time, review the recordings and try to solidify these points in your mind. And then when I start talking about the charts and the stuff next year, which is really like 2 or 3 weeks, okay, we're going to start from scratch and break down the modules. Isn't there a big surprise announcement, or did I miss something? I don't know. What's the big surprise announcement? We're having a town hall meeting on January 2nd, I think at 7 o'clock. You'll get a link in an email regarding that. Everyone is invited. We're going to talk about the future. Is that what you want? Is that what you wanted to hear? All right. You know what? Let's do this. This is kind of silly, but let's do this. Let's get the dinner break out of the way because I don't want to get on a roll. And let's not do a full 30 minutes. Let's do like a 20-minute. Let's get the dinner break out of the way because last night went long. And you know what? I was talking about the school shooting, and I didn't say anything about Jim, and I apologize for that. Jim did a great job last night, and I'm proud of him, man. He's really come a long way since we met, and he's developed that group, and he's done a great job, and I didn't say anything about that, and I'm sorry because there was some sad news today. So, okay, let's do a 20-minute dinner break, a short one. And then we'll talk about, I'm going to use the TDI and show you how to checkpoint it. So I don't have to stop in the middle of TDI and break. I'll go through it for an hour, and then I'm going to turn it over to Joe, and he's going to show you how to homework all this stuff. And he's going to show you what he did to build confidence in what he's doing. Just so you know a little bit about Joe, the new guys, he's trading 25 standards, and he used to manage money before he met me. And he was involved in some broker issues where they stole the $4 million from him. But anyway, he's here, and we're in a good place. Yes, stop loss too. We'll talk about stop loss. Actually, this is what we'll do. Let's do stop losses now. Let's break for dinner, and then we'll do TDI. I think that sounds like a better placement. All right, you guys cool with that, or I got you all excited about eating? All right, let's see. Stop losses. Where did I have that? All right, some people want to eat. Stop loss, eat. No food, eat. Alan, I think you're the only one that's really hungry, brother. Got to refresh your Diet Coke. Let's do it. Let's do it. No, no, no. All right, we're going to do stop loss. Sorry, Alan. Go grab a sandwich. I'll wait for you. Not really. All right. Hey, Wayne, cars got me covered, brother. Save your money, man. I feel really bad. I think that's really nice of you. Just want to send me some cake from up there, but I just got one today, brother. And I'm going to look like a cheesecake if everyone sends me something to eat. All right. Let me blow it up. All right. We'll do stop loss levels, and then we're going to eat, and then we'll come back and do TDI. We'll be good to go. Okay. Take positions of these. When you understand the market and what's going on is you need to simply buy or sell third level stop triggers on the second leg of M or W formation, and it's game over. Okay? That's the stuff I was showing you. You trade those structures, and you stay out of the middle of the chart. The middle of the chart is for chumps. All right? You should write that on a little plaque, and when you take a trade in the middle of the chart, you remember that I told you that. The middle of the chart is for chumps. Don't trade the middle of the chart. You're trading the fringes, the lunatic fringe, the outer edge. The reason that that's difficult to do is because you're going against the rest of the world. Okay, what does that mean? When the chart is at the extreme low, the rest of the world is short, and I'm telling you to take a long position. When the chart is at the extreme high, the rest of the world is long, and I'm telling you to short that sucker. That's what the extreme is. That's the lunatic fringe. You got to change your mentality and realize it's the right execution against the retail and in line with the dealer. Okay? All right, Wayne, send me an email, brother, and I'll get with you on that. All right? I haven't had a chance to look at emails, by the way. I'm slammed. Okay. Always buy or sell in the consolidation levels when the market comes to rest. That goes along with don't chase the rising or falling currency. You don't need to go, oh, there's a spike. Let me hurry up and get in. I'm missing it. No, that's not what you're doing. When the dealer makes the spike, that is, you don't have anything. When the dealer does this, when he does that, you have nothing. There is nothing there. That is not a trade. All right, Steve Post, that is not a trade. I'm kidding with him. All right, when he does that, that is not a trade. When he does this and holds it for how long? 30 to 90 minutes. And if he does that, that's a trade. If he does this, that is not a trade. If he does this, that's a trade. Understand? This is not a trade by itself. This is not a trade because we anticipate him widening the swing. That's a trade. See? Are you awake? That's the first leg of a trade. That's the trade. That's the full trade. No trade. No trade. Trade. All right? And I hope you're surprised I drew to them. I'm trying to be more versatile. All right. Only trade on closed candles with multiple confirmations. What are the multiple confirmations? Vector 3 to the low, Asian range less than 50 pips, visible stop hunt in the shadow, the right time of day, brink shadow box perhaps, for multiple confirmations. Remember, the pattern sets up at 5 o'clock in the afternoon. That's a gamble, may or may not pay out. The pattern sets up at 3:45 in the morning where it forms the low of the day. That's a lock. Take that. 10 times out of 10 times when you see it. All right? What I want you to learn to do is, I just said this, is go against the herd. Sell upward stop hunts, buy downward stop hunts as a structure. Only after the market comes to rest and calms down, when the signals appear, the stuff that I just listed. Always be prepared for one more move at the stops. That was the structure in Australia that the guy violated here after he made this. Okay? Be prepared for that. That is a non-panicking situation when you understand the market. He hit the stops. Okay. I expect that. He got me. Big deal. Now, how do I respond to that? Well, he closed back below exactly like I needed him to do. Everything else is in harmony in the universe as far as the setup Steve's talking about. I'm going to take that short again. And I'm going to make back my stop loss level or my stop loss. All right? If the dealer gives you the stop out, okay, if you're not in a position and he gives you the stop hunt, extra stop hunt, you got him. If he stops you out, that should give you some level of clarity on the chart because he made the exact behavior you were anticipating. He issued for you exactly what you wanted. A clean and concise stop hunt above yesterday's high tracer, back into the range, and now you got him. Okay, an oversimplification would be if the dealer hits the stops high, you sell. If he hits the stops low, you buy. That's the entire business based off of the high and low of the day at the appropriate timings with a little structure. That's the business. It seems like an oversimplification, and it is to a degree, because I don't want to sit here and say, oh, it's that simple. But really, in essence, if you can learn how to identify those bigger structures on the chart, it is that simple. Stay out of no man's land and no woman's land, Helen and Gloria, and you'll be fine. Okay? Managing stop loss levels. Okay. Market makers trigger the stop loss levels in 25 to 50 pip increments depending on the pair. Why? Because that's where everybody puts them. Go read any book, and the average stop loss is 20 to 30 pips. Some people are a little smarter than everybody else, and they make them 45, 50, 42. The only stop loss placement is above the high of the day and below the low of the day. If your stops are triggered, don't panic. Simply buy or sell at the next level strike zone and continue trading through. profit will be realized. Okay? And if you think about it, you're not going to be wrong that many times. Okay, typical example. These are real-time examples that happen to people in the group and myself included, okay? The dealer made a nice possible vector to the low, 1, 2, 3 to the low we saw, right? He came off, went into consolidation, held it for the appropriate amount of time. There's 0, 1, 2, 3, 4, 5, 6. Man, that looks pretty good. I like it long. Anticipating this, the dealer came in, and if you measure from here, consolidation to consolidation, or tip to tip, he dropped down exactly 25 more pips to the pip. Or should I say to the pipette. He came back. There were stops built up below. He had to have them. He made one more swipe at the stops, and then he made a perfect formation and rose for 75 pips. If you would have let this deter you in your understanding of the market and walked away, you would have lost your opportunity to book a profit. Okay? So understand that they hit the stops in 25 to 50 pip increments. This happened to be Australian, where the stop loss levels are triggered at about a 25 pip increment, and now even less because of the low volume, about 15 to 20 pip increments. And that'll pick back up. Don't worry. They'll get it for you. Okay, real-time example. The dealer, Euro Yen, had an overblown box. He made an aggressive 3 to the low and went into consolidation. He tapped it, came back above, missed it on the second try. This looked like a nice formation to go along. But what happened was market makers needed to extend the low. There was possibly too many contracts down there, and he did it in perfect fashion. He went down another 1, 2, 3 to the low, and I can tell you that from here to here was 50 pips, or from consolidation to consolidation was exactly 50 pips. Yen crosses, EJ, GJ will trigger the stops in about 50 pip increments. Pound dollar, 50 pips. Euro, 25 to 30. The dealer will trigger those levels. Why? Because that's generally where people put them, and on the yen crosses, people know that the range is bigger. So they go, oh, I'm going to show these guys on Euro Yen and Pound Yen, I'll use 50 pip stop loss. They know about that. You ain't fooling nobody. Okay? Keep your stops tight, and if you're wrong, lose a little, and when you're right, win big. Now, if he stopped you out here and you went crying to your mother or your wife and you didn't take this next setup, there was a 275 pip run here. Easy. And if you would have controlled your loss down to 15, 20 pips, you would have been net 30 for the cycle by not fearing and understanding that the dealer just needed to handle his business and pick up some more money. That's what they do. All right, that's the business. So think about this. There are 3 levels of drop or rise. There's 3 moves towards the stops. If you're going to be wrong, you're only going to be wrong 2 to 3 times. If a pair moves up 50 pips ADR, simply buy or sell at 50 pip increments until you stumble onto level 3 and you'll fall into the money. Now that's a little ridiculous. It's not a real strategy, but think about what I'm saying to you. If the dealer does this, 1, 2, 3, and you went long here and were wrong, and you went long here and you were wrong, well, if you finally caught the right level and he comes back into the range, you'll finally fall into the money on the second or third attempt. Okay? So what I'm telling you is, I'm not telling you to start balling up $100 bills and throw them out the window, but I am telling you that you understand how the market is structured, and the dealer only has so many things he can do to get you out. He can hit the stops a couple of times, but he's not going to move the entire market to come back after Helen. Okay? He is going to hit it, analyze his book, hit it again if he needs to, analyze his book. If he has what he wants, he'll reverse off of that number. It's always about the money. So when he does that and he grabs your money, think of all the other people that he grabbed. Now think opposite. Think like him. Okay, if I just grab 500 million, what would I do? I know you retire and go to Tahiti, but if you just grabbed 500 million, you had to stay working, what would you do? You'd hit the next level, form the W or the M, and then reverse off that level with the newfound money in your hand, because he has the opposite position that everyone else has. So if he grabbed a buy, everyone else grabbed a short, he will rise off of that number. That's what you have to understand, okay? And I can't say this enough. This is not a real strategy. Don't just start saying, oh, I'll just take 3 trades in a row, boom, 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 until I hit it. No, it's not what I'm telling you. All right, managing your stop loss level. Once the trade is on, a stop loss of 23 pips below the LOD or above the HOD should be used. This is the safest stop loss level. Why? For all of you first leg traders, impatient, got to have it right now, microwave society, this is your stop loss. Okay? You got to have instant gratification right now. You take the first leg. The stop loss should be 23 pips above or below the perceived LOD at the time, or HOD, right? Now, why 23 pips? This is the exact number that was given to me from the dealer. He told me that a rise bigger than 23 pips, he told me it has to be in the 20s, low 20s, and a prime number. Okay, is 23 a prime number? I think it is. All right, so look. A lot of times when they come back and paint the second leg, it will be about a 10 or 15 pip break of the high or a break below the low. They will just tap it, and that comes in about 10 or 15 pips. And you can go and see this and look at it. I've seen it. They'll just miss that stop loss level forming the second leg if they come and break. And opening of the spread, they'll be damn close, but they won't take you out. If they take you out, you needed to be out, because a move greater than 25 pips or 23 pips above or below will possibly warrant next level stop hunt. Right? And you're going to get taken out. Don't sit there like a moron and watch them take your stop out when they close above or close below. Scratch yourself out because you know better. Don't let the market prove you wrong, because it will. In order to trade multiple contracts with little to no drawdown, second leg entries need to be mastered. Second leg trades can use a stop loss of 7 to above or below the HOD or LOD for a total of about a 15 to 18 pip stop loss total. And I know some of the guys are getting them down into like 10, 11 pips total by hitting that second leg mastery. Okay? Think about this for a minute. You always want to trade heavy contracts but can never risk 30 pips on the contract size. This is your opportunity. Become a second leg master. Okay? Let's look at this. Let me draw it for you. First leg. Second leg comes in. You could bring the stop in just like that, tight. Why? Because he ain't coming back, baby. That's why. If you get in here and your stop loss is out here, there's a chance that this will occur. Right? But most of the time, if the second leg appears at the appropriate time of day, the second leg is all the dealer is going to offer. And the second leg brings the quote, he ain't coming back, baby. So grab it, tighten up your stop, and take a ride. Usually if you start to learn how to deal by the hammers right before the shift bar, you'll make a good entry, tight stop loss, and the dealer will shift in your favor almost immediately. 15 to 30 minutes. You'll start to see a fall off the high or a rise off the low. Okay? The stop always goes outside of the dealer's grasp or reach. Always. Okay, so when the second leg comes in, you know the high is set for the day. The stop loss goes here outside of his second pass. If he makes a third pass, he may get you. Okay? Absolutely. Pairs that have big spreads should include that number in the stop. GJ is the one that comes to mind. Depending on where you're dealing at, GBP odd sometimes runs up 5 or 8 pips. Just add a few more pips to it. Okay? So make sure we're clear. If you're a first leg trader and you can't stand it, 23 pips above the high, 23 pips below the low. That's the safest place you can be. And if you're wrong, you need to be out. Okay, second leg, I want you to become a master at getting that stop in there tight. Right up in there and right up in here. Okay, you're not above the high. The high of the day is the safest, best possible stop, but you're never going to trade 100 standards and have that loose of a stop. Can't do it, because if you're wrong, you'll destroy your account, but if you're right, you'll triple it. Depends on your account size, I guess. All right. By the way, the biggest, I don't know if Tim beat him, but the biggest trade that I have on record is actually better than my own, and that is Rick with, if you guys remember last summer, I probably shouldn't say the number, but I'm going to say it anyway. He's going to be mad at me. He hit 306 when it spiked 1,000 pips. I think he told, I'm not the only one he told, right? I think some people, he was heavy. He was in heavy. I think he had 100 plus standards, and he caught the W formation, and it was starting to tick up a little bit, and then it just spiked like 900 more pips. All right, it was good stuff. Yeah, some of you saying Rick's not quite a super duper yet. He's getting there. He can't hang with you, Dave. I know you're the man. Yeah, a lot of you saying you remember how awesome that was. That was pretty great. Very happy for him. That's more than most people will ever accumulate in their lifetime. He made it in 90 minutes. It's crazy, right? Good stuff. Okay. Let's talk about, if you have a good grasp of the method, you're going to rarely be wrong in your trades. That's important. You're going to be wrong. You have to internalize that as part of the business. If losing money turns your stomach, maybe this business is not for you. You got to figure out a way to understand. I talked about managing your risk. You need to know if you have a $100,000 account balance and you're risking 10%, the loss on that trade will cost you $10,000. You have to understand that. So if you put 20 standards on and you're wrong with a 30 pip stop and it costs you $6,000, you got to understand that going in. I said yesterday, analyze the risk before you take the trade. If you have the same $100,000 account and you trade one standard and you get stopped out for 10 or 20 pips and it costs you $1,000 or $2,000, that is a 1 to 2% risk. If that same trade goes to 50 pips profit and nets you $5,000, that's a 5% return on a 1 to 2% risk. Those are the things Jim talked about last night that you have to understand and learn how to come to grips with. If you losing $1,000 rattles you, it would if you had a $1,000 account, but if you have a $100,000 account, understand that you're not going to be wrong. You're going to be right if the dealer just triggered your stops. If you're not seeing the stuff clearly, do not trade real money. That is the beautiful thing about trading business that I've always thought was like genius. And here's what I mean. They give you as many practice accounts as you can handle, more than you can have in a lifetime. When's the last time they ever allowed you to mock up a shoe store and see how it does? When's the last time they ever allowed you to mock up a McDonald's in the middle of the desert and see if there are millions of dollars into a business, hundreds of thousands of dollars into a business, and you open the doors and you pray that people show up and buy your product? In the Forex or trading business, they allow you a demo account to practice. The problem is people never use that account like it's intended or meant to be used. And what I mean by that is that if you have $10,000 in your bankroll and that's what you're going to open the business with, then your demo should be $10,000, and you should work it as if it is real and learn to take only the setups and discipline. Look, Scott's saying fake money is not the same. That's a discipline issue for you. That's on you. You got to say, you know what? I have a free demo account that I can have numerous shots at to try to master it. And I always say this in class, and people like roll their eyes at me, is that you have no business trading real money until you can double a demo. Right? With real accurate trades, with real good setups that you've had good entries. If you have $5,000, then your demo account shouldn't be 5 million. Nothing makes me more crazy than and people come up to me and tell me, man, I opened up a $10 million demo and I'm up like $200 million. I'm like, man, that's fantastic. How much do you have to start your real account with? I got 50 bucks, man. I'm like, what? What are you doing trading those sick numbers that can handle open float and drawdown if your reality is you got $1,000 or $100 to put in a live account? If you got $500 to start your account, then you need to be trading a micro demo with $500 in it. Right? Charles, I've heard that too, but if you can't see the setups in demo, and Scott brought up a good point that you don't treat it like real, it's psychologically different, okay. But guess what? If you can't see it and grow an account in fake money with no financial pressure on yourself, how the hell are you going to see it when you got $5,000 on the line or $3,000 on the line if it took you 6 months to save that money? Think about that. They're offering you a crack at the business that doesn't cost you anything. And absolutely, Robert, if you can't make any money in demo, how the hell are you going to make money in a real account? Treat the demo like the gift that it is. Save your real money because you worked hard for it, and work the demo account, seeing the setups, and trade it, and systematically approach it. Take 1 or 2 trades a week on a real size account that's realistic for what you're going to trade. And as that demo grows, save the statement and say, okay, I grew my demo account from January to March in the first quarter. I'm up 100%. I've only taken 3 trades a week. I took perfect end and W formations in that account. My discipline was there. I'm ready to go live and put my real money on the street or out there. That's how you approach it. That's what the beauty of a demo is. How many people wish they could have opened a demo business of anything, a shoe store, McDonald's, a Chick-fil-A, anything, to see if it would work? I can tell you right now, with the economy being bad, I bet a lot of people wish they had demoed something. Because go up and down the street, there's boards on everything right now. The economy is bad. People are hurting. And these guys are giving you a free opportunity to learn how to implement a method without any real risk to yourself or your financial status. Think about that. I know that a lot of you blew your account, and that's how you got here. Byron just told me that he had built his account up nicely and blew his account on one bad trade. Horrible, horrible stuff to hear. No one trade, there's a theory I always say, no one trade should make or break you as a person, as a trader, as a husband, as a wife. Should never wipe out your entire equity in your account included. It's a simple matter of he didn't understand the structure, and he probably lifted his stop and let it ride, hoping it would come back. Sorry about that, Byron. Or he might have had 200 standards on a $5,000 account, over leveraged. Right? Yes, all the sayings apply. Learn to crawl before you can walk. Learn to do something else. Whatever cliche you want to add to it, the point is, and if you treat it like a real thing, you don't put 5 million in it when you only have 10,000 open account. You treat it real and take it seriously, then what happens is when you go to execute real money, the discipline and the fundamentals of your internalized stuff, your personality, your foundation to execute properly will be there. If you start trading demo like a cowboy and tell yourself in the back of your mind, oh, it's demo, I could do whatever I want, then you're going to do whatever you want with real money and blow it. Okay? So, yeah, there's another one. If you try to hunt your prey without tracking skills, you might starve. I guess that one's from Minnesota. All right, man, look, I went over. Let me see, a few more slides on stop losses, and then we'll take the break. You guys take my advice for what it's worth, right? And what do they say, that and a cup of coffee, or a dime and a cup of coffee will get you a phone call? Not even anymore. A cup of coffee and a quarter, I don't know. You know those old sayings. But look, I say these things, and then people write me emails and tell me they blew their live account, and I go,